Alright, let's talk about how interest rates affect gold and inflation. We have a pretty unique case with interest rates, and let's get into how it's typically used to keep inflation in check. How it is basically they raise rates when your central bank to keep inflation in check, because if you promote debt by having low interest rates, more people are taking out loans from their banks, everything like that, the lower rates are for the banks to get, the lower they can make a profit off of giving rates to you, and they are competing with other banks, so they lower their rates that they'll give you when you take out a loan or anything. Or it works the opposite if you're saving money. If you're saving money, you get less on your savings and interest. You don't accumulate as much money over time with lower rates. And it's cheaper to pay down debt with lower rates. It makes debt more affordable. If you loan $100, 10% interest rate, you're paying $110 back. If you loan $100 with a 5% interest rate, you're paying $105 back. It's basic math, and it works the opposite for savings. So as you can see, promoting debt with a low interest rate also discourages savings, because you get less for your savings. If you're getting less for your savings, less people are going to be saving money, because it's discouraged, essentially. That you're taking away a route for people to beat inflation just by holding on to their cash, leaving it in a bank, essentially. You used to be able to get a 20% interest rate. That used to be the standard, meaning the banks would give you probably 17.5%, 18% interest rate. Somewhere in that ballpark, that used to be the norm. Now we have these record low interest rates. Places are going negative with rates, all to make their debt more affordable. That leads to a lot of people taking out debt with the low rates. It's more affordable. It's promoting the debt, and when you promote debt, more people taking out loans, that means more money is circulating, which raises the rates of inflation. Basic supply and demand. It's just supply and demand with the dollar when it comes to inflation. And it all does come back to gold, because gold is a hedge against inflation. When the dollar drops, gold goes up. That's how it works. Now, if governments are running up these massive debts, record levels of debts, and they have to do things like yield curve control to keep the rates low, make it so that they could actually afford the debt that they're taking on, they're not going to be able to raise those rates, because it's now going to bankrupt their nation, essentially, because they can't afford the debt. It's going to make them insolvent. So that's taking one of the biggest ways to stop the inflation from happening, and you're just kind of tossing that off to the side. There is the number one tool to stop inflation taken away. Before we had all this money printing, just something to think about, and because when there's no tools to stop the money printing, you get things like inflation's going to be hot. I really do believe that. I think that inflation is going to be real hot as soon as people start spending money, I think it's going to be above this 5%, what everyone's predicting, because once inflation starts to go above 2%, it'll start to make people nervous, and people start positioning themselves for higher inflation, which causes more inflation because there's less demand for the dollar. There could be a downward cycle from there, and the higher the inflation gets, the bigger that effect becomes. Since governments essentially are stuck with these low rates, central banks are stuck keeping the rates low to make nations' debts affordable, you can't stop that inflation. It's just going to keep going and going and going. And if that does rise, that'll cause way more major uncertainty in terms of economics, because if you do raise the rates and countries can't meet their obligations, it causes uncertainty really with the dollar, people can't trust the dollar. They're going to invest elsewhere. They're going to start to exchange their currency on the Forex for different currencies. They could be buying gold, they could be buying silver. That does typically happen, which raises the price of gold and silver. A few things to think about, because I think a lot of us are anticipating high inflation coming up. I don't think this time is different. I think all the rules of economics always apply. I don't think suddenly the rules of economics stop applying. I think there is some things that are just there. Certain equations, 1 plus 1 will always equal 2. It doesn't matter what language, what time in history, 1 plus 1 always equals 2. That's kind of the way I look at economics. Certain equations are there. The equation is the same as previous like if the equation's the same as previous points in history, the answer is going to be the same. It doesn't matter what language they speak it in. It doesn't matter what time of history it's told in. Equations always have the same answer. If you rate the same equation, you'll end up with the same answer. And to think otherwise is a bit odd from my personal perspective. Just my thoughts, just my opinions though. And I'd love to know all of your guys' thoughts and opinions. What you guys think about inflation and how that'll affect gold. I think gold has quite a bit of ways to go from here, because all this money printing, the low rates of inflation that are basically locked in previous to the money spending, all the money printing, debts have risen a lot since then, and this was all meant to make debts affordable. Something to think about, something to consider when you choose which metal to stack, how you want to go about stacking them, and yeah, I'd love to know all you guys' thoughts and opinions. Stay positive, see you next time. Thanks. Bye.